Hello, everybody. This is the September edition of the UNW Dental Insights webinar, the second one in a series, which hopefully will be going on for some time. The first one was very successful. We had some great feedback. So those of you who are watching for the second time, welcome back again. And we've taken on board some of the positive comments about how to improve things. So we'll be building that into what we're talking about tonight. Whilst we're waiting for the number of attendees to build up, I'll just talk in general terms. I don't want to introduce a panel member who then is talking to a virtual room with nobody in it. So I'm keeping an eye on the participant numbers, and then we'll pass on soon. For those of you who are here, if I can talk about what's going to happen when you exit, it is really good if you wouldn't mind giving us more feedback. We have listened to what happened last time, so you'll be asked to take part in a very simple questionnaire when you exit the virtual room. So it'd be helpful if you could do that. Otherwise, our aim today is to help you with really topical points. So we've got people from all of the key advising professions to dentists, and so I've asked them to think hard about what are the interesting things that have been happening recently that you would like to know about. But there's also the facility to have questions and answers. For those of you who are familiar with Zoom, then you'll know what to do. But for those who aren't, then down at the bottom of the toolbar, there is an icon that's marked Q&A. If you click on that, you can pose questions. And there's also another box for chat. Chat is really just sort of for the banter and the witticisms. The Q&A, if you can use that for questions, and I'll be asking as host, keeping an eye on that and asking the panelists answer the specific questions that you have. Just to quickly run through the panel, we've got two of the top guys from Christie's involved here. We've got Paul Graham, who's head of dental, and we've got Chris Vowles, who's head of valuation. So we've struck lucky tonight with Christie's chartered surveyors, international experience, but they're two top men in the dental field. So welcome to you guys. We've got, from the legal standpoint, we've got Louise Fegan from Morrisons Solicitors, members of NASDAQ, and deep dental experience on the legal side. Banking, we've got Clarke, who's head of Wesleyan Bank. Wesleyan are part of, there's the Wesleyan Group, which includes other important players in the dental world, practice plan, etc. So there's a wide range of experience there, and of course their investment advisors. On the profit improvement stakes business coaching, we've got Andy McDougall from Spot On. These businesses has flourished dramatically during COVID. I think him and Amazon have done very well during COVID in building up their businesses. And we were chatting about that this morning. It's interesting how things have developed for some types of businesses. And those of you who are watching this, there'll be a lot of you who work with Andy. It's really important, obviously, in the current climate, to know what your numbers look like so that you can make them better. From UNW, there's me, of course. I head up our dental team. We've got Charles Lineker, who's an ex-inspector of taxes and tax partner, and Katie Lamb, who's a senior corporate finance executive. And is our sort of secret weapon, in a sense, that she's not only got very high-level corporate finance skills, but is married to a dentist. So those of you who are practice managers married to dentists, then you can have some sympathy with her, or empathy with her, should I say. Clearly not sympathy, that's a slip of it. And then finally, we've got, with absolutely no nepotism whatsoever, we've got a dentist on the panel. We've got Nigel, my son. Nigel owns two practices that were initially mainly NHS, but he's been building up the private side quite successfully. There's a lot of implant and, if I can call it, cosmetic work. And just for a bit of amusement, I wanted to show you this, because those of you who were watching this webinar last month might have noticed my horrendous bottom jaw. This was it. You can see, there we were. This was me last month. And this is me now. Well, it's chalk and cheese, isn't it? So, you might be interested, dentists what the hell's been going on here? And so I've had a lot of people have been asking me that question, including some of the panelists, and I refuse to sort of spill the beans. Here we are. Basically, I saw this problem on a webinar a few months ago before COVID. So I've got to do something about this. This is a nightmare. So I talked to Nigel. Nigel did a proper job on this, said, why don't you go and see one of your well-known and eminent orthodontist clients, because it could be that he would give you some advice that you'd want to take. I did that. We then had a bit of a chat about other alternatives, implants, because Nigel's an implantologist. But I came to the conclusion, the other option, and he explained to me, those of you, the dentists watching this will know all about the evaluating your patient as if it was your daughter. Well, that's quite novel, seeing as I'm his dad, but age is a significant factor in this that you will be aware of. And because he didn't say this, but I sort of got the impression that the life of the treatment has a greater life expectancy than me. So there we are. That made the decision somewhat easier. So I've got a canine bridge, 2 canines with a bridge in between. It's only temporary at the moment, with 4 teeth that were extracted. So there we are. And of course, I look much more handsome than I used to. So with no more ado, I'd like now to pass on to the guys from Christie's, particularly Paul Graham, to kick off. Before we start asking questions, I came across, Chris showed me a presentation that, or a report that Christie's have just produced about the latest state in the dental market. I thought that was so good, the extract of it would go down well now. So over to you, Paul, if you could give us a whisper of the findings.
Great, thank you, Alan. I'm just going to share my pops up. Can everyone see that okay?
Yes, we can, Paul.
Excellent, great. So thank you for inviting me along this evening, Alan, and making reference to this particular graph. It's some data that we've been collating since the turn of the year. And
Paul, you sound very muffled. In the absence of anything knobs that you can twiddle to make it better, maybe if you can be a bit closer to your microphone.
Yeah, sure. I'm getting some feedback. Maybe can
the rest of us should mute, I think.
Yeah. Just give me the thumbs up if that sounds clearer now, Alan. Yeah, perfect. So the data that we've been gathering during this COVID period, we wanted just to analyse it a little bit further and map it out in a graph. So whilst you're just absorbing the pattern of where those months have been, let me explain what the data entails. So this is value of practices and offers that we've received from January 2020 to the end of August. The data excludes group offers exceeding £10 million, and therefore it's reflective of the core volume market. The graph is also reflective of activity throughout all regions of the UK, and it clearly displays a sharp recovery in interest received across the kind of full spectrum of practice types and sizes. So it doesn't exclude private, it includes both private and NHS practices. The interest has been really driven by an influx of buyers, existing operators, associates, as well as the regional corporates and national corporates who we're all aware of. The aggregate offer value for the 2 months in Q3 that you can see there, so July and August, exceeds that of Q1 by circa £20 million. So quite a significant rise in the most recent months. Again, both the offer volume in both July and August has been greater than in any month year to date. We actually earlier today, and it's not on this graph, but compared it to Q4 2019 as well, and indeed the recent data exceeds what we achieved at the end of last year. Total aggregate offer value, as you can see on the right hand side, to the end of August is £135 million. So it really shows quite a sharp recovery in value that's being extracted from the market. And I think what we expect is aggregate offer value in Q3 to exceed the total combined value in Q1 and Q2 put together. So another couple of weeks of this month. Alan, you're still on mute.
Yeah, I'm on mute, and maybe if the rest of the panelists can as well, so we can sort of come in there. I say that's really interesting. I know, Nigel, you had a question in relation to this, which I think Paul has partially answered, but do you want to pick up on this?
Yeah, well, a couple of points. First of all, as a dentist with a vested interest having a couple of practices, although I'll be clear in case there are any of my associates watching, I'm not planning to sell. But having two practices that have a fee, sort of a turnover of less than 750,000, it seems like lots of deals are being done on the bigger practices, and they are getting what seems to be good offers. Is there much hope for practices with a lower turnover of sales? And also, just from chatting to friends who have sold, or to seeing sort of stuff on Facebook groups and what have you, is it mainly, are the deals mainly being done by corporates or mainly sort of associates buying, or practices increasing their group size?
Yeah, really good question there, Nigel, and a couple of questions. And just to address those, since 2019, January 19, Christie & Co have sold 80% of our practices that we've been actively marketing to independent buyers. So the bulk of the market, the core market, is independents who are buying either the first practice or growing a bit like you have, second practice, third practice. The corporates in the UK market just now account for about 15% of the market. They will hone in on practices of a certain size, scale, and typically as a result of that value. It's a small proportion to the bulk of the market. So as you can see from this graph, those numbers would be subdued quite significantly if we were just focusing on only corporate activity. Mm-hmm. So this represents a wide range of independent activity in the market. So having practices with turnover less than £750,000, that's the market's been fed from the bottom up. So I think there's a real sweet spot in value that you've got there for practices with that type of turnover. It makes it very viable for the purchaser coming in. It'll be an attractive option to the market.
Yeah, that's great. Thanks, Paul. Could you stop sharing the screen now? Because I've got a question here. A couple of questions have come in on the Q&A, which I think are more for Chris. So the first one's from Ian Boyd, who's a good client of UNW. So asking, are the valuers giving the same figures for the worth of practices? So I think what he's meaning there is the practice agents and the valuers, are they coming up with the same sort of numbers? Or if there's because he's saying if there's a difference, then it's going to be difficult to borrow money. The second question, just I'll give you two to go to run at here, Chris. This is from an anonymous attendee. We've received several valuations from the popular dental agents. The valuation from a well-known agent is considerably higher than the others. Not sure what to make of this. Curious to understand why one could be so much higher than the rest. So there's a couple for you, Chris.
Yeah, both quite interesting questions. If I start with Ian's first, I think that's a question you could have asked pre-COVID. So I think that's relevant anyway in our markets, because the business is worth X amount of money and it's assessed by a valuer based on looking backwards. All of the agents will be looking forwards to try and set the market. And obviously a valuation is modelled against actual transactions and deals that have completed that aren't about to complete or will be happening in the next 12 to 18 months. I think also what a valuer is instructed to do by the banks at the moment is to reflect two numbers. One is a pre-COVID valuation, i.e. forgetting that COVID's ever happened, with a valuation date of February, and then a valuation date as at today reflecting the closed period and the most relevant trading information. So the thing that Ian doesn't realise is that a valuer is there to protect the interests of the bank, but also the buyer as well to some extent, because if you're paying over market price or paying over the sort of market value of that practice, it's the valuer that will identify that, and then actually that's where you should renegotiate, or you should look at bridging the gap. What a valuer does take into consideration is everything, and works backwards over 2 or 3 years worth of accounts. We'll get into the nuts and bolts of a business, and will not just look at a basic set of accounts and come up with a number that's sort of out of the air to some extent. And also that does lead on to the second question, which is pick your agent. There are some agents that are more experienced, that have more of a transactional knowledge, that are RICS backed like ourselves. But I think it's important whenever you're looking at these things to understand why they're so much higher. Actually interrogate the agent as to what they've done, how they got to that number, why they're so much different to someone else, and not just go with the highest figure. Because arguably you could be 3, 6, 9 months down the line with an unrealistic figure and not actually have achieved it. So I think it's always worth picking your agent and asking some salient and poignant questions to make sure you're with the right people. And that will protect the value as well.
Okay, thanks very much, Chris. If I can move on, we'll hopefully have a chance to circulate, come back for more. Okay, go on, Katie.
Yeah, I've got a question for Paul and Chris. Do you think that uptick in activity is just pent up activity from COVID and the lockdown, so do you think that will continue? So that's the first question. And the second one is around, do you think it's sort of a buyer's market or a seller's market at the minute?
I'm happy to pick that up. I think in terms of the pent up demand, do I think it will stabilise? Yes, I think there's clearly a spike there, and I mean, it'd be great for us to continue to see that spike, but I think in reality it's going to even off again. Why do I think that spike's happened is probably because whilst the situation in the profession is far from ideal just now, those who are looking to buy have probably watched their principals have a lot more financial support to lean on compared to the self-employed nature of an associate. So I think that demand is clearly spiking because it's a safer place to be owning your own practice just now and securing your future within dentistry. In terms of being a buyer's market, I think when we'll probably touch on this later in the seminar, but we talk about demand and multiples that are being achieved, multiples of EBITDA to determine value, and how do we get to those multiples? It's been driven by demand, and I think the one clear pattern that we've seen without question during this period is that the demand is still there, that the interest in practices is still there. And I think whether that be independent investors or third-party investors, they'll look at healthcare as a needs-based sector, a safe haven for investors. And I think having that formula there will always mean it's going to be a good marketplace for a seller. I mean, there'll be certain softening round the edges. There'll be a new wave of seller who are perhaps not financially motivated to trade out of this period or fix their business, and as bizarre as it sounds, probably enjoyed lockdown and thinking, actually, just get me out of my practice now at whatever price. So I think there'll be some examples like that, but equally a good business pre-COVID will continue being a good business post-COVID and achieve significant interest and demand.
Just to add to that, Katie, if it's all right, and perhaps bring John in as well. And Ian's asked another question based on the valuation side of things. But yeah, Katie, I think the majority of work that we've been requested to do or been asked to quote on in the last 6 to 8 weeks has been sub $1 million, with a lot of that being around the £500,000 to £750,000 mark, which is what Nigel mentioned earlier. And a lot of it is new finance, first-time buyers, and as Paul rightly said, it's associates who haven't earned or have earned a small proportion of wage based on the NHS proportion of business they've been doing at that particular practice. So we are seeing a lot more people come into the market to buy those practices. And it wouldn't surprise me if we started to see, which is why I'm bringing John in, the bank of mum and dad bridging some of the gap, as Ian has rightly said, on the difference between a valuation, which is what the banks rely on, and you know, it's their go-to document and the actual price achieved and paid for that practice. Because there are practices out there where we will value at one level, but if you've got 3 or 4 people who really want to buy that practice, it will come down to who's got the most cash in the bank or in their pocket to buy it, irrespective of where we come in. And you probably want to add to that, John?
Yeah, go on. Over to you then, John. That's a good point to bring you in.
Yeah, I completely agree. I mean, to a lot of the points that Chris and Paul have made, there's a lot more interest at the minute from first-time buyers. A lot of them feel vulnerable, hence why they're looking to create their next or new destiny. There is a lot of talk about Bank of Mum and Dad around the purchase price because there's 2, 3, 4 people looking at practices. I think from our perspective, and again to Chris's point, the valuation is the security for a bank, the lender, and it's also security for the acquirer. And they've got to evaluate if they're paying over the odds, when are they going to get that back? And actually, is it the right decision for them? But, you know, personally, I advise them, it's down to them, whether they negotiate, which in my humble opinion is the right thing to do, or whether they do just stump up that additional cash. You know, that is very much my view.
Okay, that's interesting, and a point that you both touched on, but I think it'd be helpful to clarify this just for our attendees that might be first-time buyers. There's been some talk, for example, there was a recent ASPD chat, and there was some talk there where there was feedback in some parts of the country where it seemed as if lenders weren't in, some lenders, I hasten to add, not Wesleyan in this instance, were not backing first-time buyers and saying that this is as a consequence of COVID. What's your situation for that, John?
I mean, I can obviously only talk about ourselves. I do hear about others in the market, but we're very, very much open for business. We were very much open for business during lockdown. Being honest, we are right now extremely busy, just as Chris and Paul have expressed that they are as well. That goes hand in hand with the offers and the spike that they're seeing at the moment. I'm looking at figures at the minute based on applications that we've got in currently, and come the end of September, we will either be at pre-COVID level or slightly higher, which certainly tells you all about the activity that's going on in the market. I would say probably out of the applications that we have seen over the last 3 months, 80% of them are first-time buyers, and we're very actively working with them. We want them. They are the new breed in the market.
Okay.
So,
can you, what would also be useful is to give an indication of what, if anything, has changed in terms of a typical applicant pre-COVID and a typical applicant now. What has changed in terms of your either lending parameters, the sort of information that you require? I think that would be helpful for people to be aware of.
Parameters that have changed has mainly been around what I call skin in the game. And that skin in the game is cash pledged up front. So pre-COVID, we were looking at a minimum of 5% cash stake. Now we look at a minimum of 10%. We have loan to value requirements, which all lenders do for private and NHS. Some lenders are particular around what type of practice that they will lend to. We're not. We will very much lend for NHS only, mixed, or just private. From a financial information perspective, then NHS, as we all know, they've been still earning during lockdown. From a private perspective, we do want a bit more information. We'd like to understand what did the practice look like pre-COVID, and have they got some management information since they've reopened. Personally, I always keep my ear to the ground. I talk to yourself, Alan, other influencers in the market, but also practice owners. And from a private perspective, I've been hearing that activity is running at somewhere between 70 and 120% of pre-COVID levels, which I take as a very, very clear positive. That they're very much back in action and they're performing very well.
Okay, thanks, John. I think that takes us neatly on to Louise, and thank goodness you're back, Louise. You disappeared.
Oh, I know. I seem to crash my back.
Okay, well, it's good that you're back, because there's a question that has come in from Sabina Hamid saying that are deals actually being done, or is there just a rise in interest? She's followed up saying that she's aware that she thinks it's an interest bubble which will burst and is time dependent. But so what are you actually seeing regarding progress of deals?
No, they're actually being done. I mean, when the lockdown first happened, I actually did have some that did complete. Some of the NHS ones, people were still very keen to do. They completed that. It's fair to say that the private practices, yes, there was a hold there because no one's going to buy a business that is closed. Having said that, I still did complete some. I acted for one guy who was a private associate, not earning any money, and he bought a private practice with a large den plan contingent. So actually, he could earn money following that. So no, absolutely not. It really surprised me actually how it's come back. And obviously with the private practices, as John's been saying, obviously the lenders, etc., want to see 3 months post-COVID trading figures. We're sort of through that now, and most of my clients, are achieving a fantastic figures. So I completed 2 deals last week. I've got a number lined up for the next couple of months. No, it's very much back in business.
That's very reassuring. Nigel, you had a follow-up point. You're on mute, Nigel.
If you're acting for a purchaser, are you suggesting that there are any warranties that are put in that you wouldn't have put in pre-COVID?
Not necessarily. I think most of the warranties. I mean, obviously that there'll probably be further due diligence questions just to see what happened during the lockdown period. No, I mean, most of the warranties cover most things. I mean, most things people are going to be worried about is trading figures, isn't it? So there'll be warranties there, probably based on figures that people have said they've achieved, and there might be retentions, etc. But no, it's generally business as normal, just perhaps with added due diligence questions and perhaps more protections with retentions, to be honest.
Well, actually, that's a really good point, Louise, that I wanted to get onto, and I can see John's champing at the bit as well. There's a lot of confusion, I think, in the dental market about retentions. And I know some lenders find it very difficult, if not impossible, to structure the lending around retention. So, Louise, if you could give me your thoughts first, and then we'll come on to John to talk about retention.
Yeah, I mean, there's a different. It's what you mean by retentions, really. First of all, yes, I'm seeing lots of people offering perhaps 70 to 80% of the price up front with 30% deferred. Now, it's either going to be deferred, so that payment is either going to be paid just with a certain time scale, say 12 months post completion, or more likely it's an earn-out. So the earn-out will be paid if a certain amount of turnover is achieved post completion. And obviously the parties have got to get together and agree that level. And it does seem to me to be pre-COVID levels that need to be achieved. And actually it's good, it protects everyone. The buyer obviously doesn't want to buy something and pay goodwill and have to pay back a loan when it's not getting the turnover. And it gives the seller the chance to achieve their full price that they thought they could get. So it seems quite a good mechanism.
Okay, John?
Yeah, I agree with Louise's points. It works for both parties. From a funding perspective, we would classify it as deferred consideration. we would actually structure it as part of the deal, and therefore the loan to value that is required within the credit policy. We would expect the acquirer to fund that deferred consideration whenever it's due. So we would ordinarily see a deferred consideration probably paid over a 3 to 5 year period. And that can either be, to Louise's point, a payment or an earn-out, depending upon what they negotiate. But as part of the funding application, we would want to see cash flow forecasts that were presented, that the affordability was there for the loan, but then there was sufficient enough cash within the business in order to meet the deferred consideration payments when they were due. But the reality is that depending upon the deferred consideration that's negotiated, the acquirer's loan or the customer's loan is going to be less than what it would have originally have been if they'd not had that negotiation. So their payments in the first initial years, or will ultimately be for the duration of the loan, are going to be lower than what they would have originally been. So they're all automatically going to have more cash in the business.
Okay, thanks, John. If we can move on to, sorry, go on, Katie.
The only thing I would add in terms of an earn-out is, if you are the seller, have a think about what kind of control you have in order to achieve that earn-out. If you're not, depending on how much you're in the business, or even from an accounting perspective, how, you know, so Louise mentioned turnover, but sometimes it's based on profitability, how that profitability is defined, because that could make all of the difference. And sometimes if I was acting on the side of the acquirer, I would use those kind of tools to make sure I, you know, minimize the chances of having to pay out extra.
Okay, thanks, Katie. Go on, Paul.
Just on that point as well, as we act for the seller, there's a number of complexities around that typical post-sale arrangement that we would always want to protect our client with. You know, I think as we've emerged into this period, we've seen a bit of flexibility from those types of buyers that would typically have a cash payment up front and a certain percentage deferred thereafter. Typically, they would target that on turnover over a 12-month period. You know, we've successfully negotiated recent deals where they've effectively made it an 18-month year, so a year and a half to deliver the same turnover, effectively bearing in mind that there's a bit of a slow build up as we leave this point onwards. So a bit more extra time to deliver on that turnover target. Equally, any underperformance in that first initial year, there's a chance to overperform in year 2 or year 3, again, so you can make up the full amount, or the full target level that as a result is going to get you the full amount of deferred at the end of the time period.
Okay, that's great. Thank you for that. We can move on to Andy now, and in the world of profit improvement and managing numbers closely. Be interesting to know that people have been asking, it's been touched on today as well, about sort of a percentage recovery, how you're seeing that on an average basis, but also the importance of cash flow. I think that's something else that you wanted to point out. So over to you, Andy.
Yeah, certainly. Well, you know, we have about 150 clients. So what I'm going to say now is probably based on that, rather than you guys who've probably got access to a wider audience. But certainly, if that's a reasonable sample to look at, they've certainly all bounced back extremely well for various reasons. I think lots of people have been saying for the past few months, will this continue? Is it pent up demand? A bit like yourself in the opening statement, Alan, people saying, I've seen myself on Zoom and decided to go to my dentist. And that's brought its own benefits. Also, throughout the country, so it's not just in any particular area, clients picking up loads of new patients from businesses that are only partially opened. And basically saying, I've been to see my dentist. I think, if I'm honest, primarily this applies to NHS businesses, but saying, I've been to see my dentist. They can't get me in till November. So I'm quite happy to pay privately to get me problem fixed. And as a result of that, I think the interesting thing is that the dentist who's lost that treatment hasn't lost the treatment. Invariably, it's lost a patient, because the patient's so grateful that somebody's got them out of trouble when their own dentist couldn't. And that loyalty seems to be, you know, loads of clients saying that they're not just doing emergency treatments. People are saying, I want to come here as a patient. So that's quite interesting, because obviously that's going to bring winners and losers. I think linking it to cash flow, I think going back to the early days in April, when we're all in meltdown, people were looking for cash flows. And I think then it was really, am I going to run out of cash? Do I need a cash flow to obtain a Sybil's loan? So we were massively busy doing cash flows. And I think some people thought that cash flow exercise that took place then was a one-off exercise to actually answer that question. Certainly our intention with our own clients is to do rolling cash flow. So every month we look at the assumptions that were set previously. We measure that against how they've actually performed, a bit like a budget versus an actual in a P&L sense, but taken down to cash flow. And of course, a lot of people said it's impossible to do cash flows. It's so uncertain. Well, you know, don't agree with that. You know, we do the cash flows. We know the further you look down the line, you know, the more the assumptions become flimsy, but certainly for the next 3 to 6 months should be fairly robust. Technique for doing that, of course, is should be able to budget your fixed costs very accurately, because they are what they are, fixed. And of course, variable costs follow the pattern of income. So if you do a reasonable stroke pessimistic cash flow forecast for income, then obviously you're hoping that you're going to outperform that and come in with a hugely favourable variance. Yes, you'll have spent a bit more on your variable costs, but hopefully you'll have a large enough contribution to cover the fixed costs under control and then straight into the bank. So the importance of doing the rolling cash flows, particularly as the circumstances change. So, you know, you're looking down the track, are we going to have restrictions relaxed and it's going to become easier, less fallow time, or are we going to have second lockdowns? All those things, as those issues become more, you know, more tangible, you're always building those into the rolling cash flow forecast. And I think we're building cash flows for two reasons. One, for operational reasons. And I think, as John alluded to, also we've seen a huge amount. I mean, we did a webinar a month ago for associates to say, you know, the life of an associate versus the life of a principal. And it's not just about, you know, I want to buy a practice because I'm unhappy with my lot. Think about what comes with that. It's not just the financials, it's all the responsibilities of running that business. So take a balanced view. So lots of people have come forward from that, as the guys from Christie's and John have alluded to. Been a massive surge in our business in terms of a new area that we didn't expect, where associates are asking, will you have a look at this prospectus and do me a cash flow and tell me if it's worth going for? So fairly big shift there in terms of the work that we're doing.
Okay, well, that's very interesting. Thanks, Andy. Let's look at it from the accountant's perspective. We've had a few questions come in relation to that. But before I do that, I want to pass on to Katie and also to Charles, because Charles, there's a specific tax question that's come up, which I know is something that's been in an area of change to do with exit taxes. But sort of hot off the press, I did say that I wanted this to be topical. I can announce the results of the latest NASDAL survey. NASDAL have commissioned a survey. I organised this amongst the accountant members, where we've taken a random selection from dental practices organised by NASDAL dental accountants in order to see what is the average situation with regard to Sybil's and bounce back loans. In other words, what support levels have practices typically taken on. So with my statistical background, hopefully what we've produced is something that is actually worthwhile and valid. We've taken an overall sample size of 121 practices, selected at random. Total fee income of those practices is £88 million. Overall, 52% of practices have taken advantage of government-supported loans. That's either Sybil's bounce back loans. and the average loan is £32,000. 11% of practices have taken out Sybil's loans, so that's something that we saw sort of fairly early on. It was a tortuous process to get through. And I know Andy's team, we got involved as well with a lot of forecasting. There was a lot of rejections of applications. The average Sybil's loan is £105,000, which represents something like 12% of fee income. And it won't be a surprise to hear that the vast majority of applicants were private practices. 41% of practices have taken out bounce back loans. Now, Nigel, I remember you ringing me up to say that you don't need one, but you might as well have one just in case. And that is right across the board. And what a surprise, with the maximum lending possibility of £50,000, the average bounce back loan is £49,000. So somebody obviously went in at less than 50. Oh, why is that? I don't know. Anyways, that's just sort of some statistical news here. If I pass on to Katie though, because you've got some interesting experience as well helping UNW clients with recovery. So what thoughts have you got that might be useful?
Yeah, I mean, over the past period, I've been working with a few of the dental clients, similar to some of the work that Andy's been doing in terms of just helping them come up with cash flow forecasting. As Andy says, you know, over this period, cash is, you know, it's pretty important. But the kind of observations I want to make is that the sense I got from everyone at the beginning was very much, oh no, doom and gloom, you know, what are we going to do? And surprisingly, with the clients that I've been working with, and it might be because they're more open-minded, they're more happy to see this as a bit of a challenge, a way to grow. A lot of them have recovered to near pre-COVID levels, if not already there. And actually, when you look at those practices, the things that they've had to put in place, once the restrictions start to lift, they should be in a pretty strong position to capitalise on that contribution and reap the rewards for all the efforts. Some of the things that I think a few of the panelists have already talked about, you know, using technology. There's been a lot of practices embracing the online consultations, and that has gone a lot of the way to improving efficiency, you know, from losing some during fallow time. And actually people have found that patients are really receptive of it, and it's probably going to be some kind of permanent change going forward. Structuring diaries, it's given people actual time to sit down, because they're being forced to, in a way, to really think about how do they earn their money, and what actually makes them money. And actually doing that exercise, if you know, you don't necessarily have to use an accountant to help you do it, but I would counsel sitting down and really just thinking about that exercise, just going through it, because you'll be surprised that, you know, over 3-4 years, you might have put prices up a little bit, but you've not really thought about how much diary time it actually uses to deliver, you know, certain things. And you might be surprised that, you know, some treatments might be delivering a lot more profitability than others, and you should really structure your diary and the way you work to match that. And the awareness of how you make your money will also kind of help you with profitability going forward. Found it quite interesting. There was practice I was working with, they just worked standard 9 to 5, but even with the fallow time, they've managed to keep productivity to more or less the same levels. And what they've done is they've gone on to a shift pattern. So previously 9 to 5 with an hour in the middle, they went to 8 to 8, 6-hour shifts. And obviously there's a lot of work there with persuading staff to do it, but they found that by doing that, even with reduced capacity for surgeries, they've managed to keep productivity to the same sort of levels. And it's just very interesting how, when we're forced to think outside the box, you know, people have a will, in a way, to get through it all.
Okay, that's great. Thanks, Katie. I've got some participation here from Sabina Hamid, who has been asking for my personal views about practice values, which so never want to resist a challenge. I can only see practice values coming back to their pre-COVID level once COVID is gone. I mean, that to me is logical. I think the sort of practices that will perhaps not attract as high values would be the mega ones that were selling to corporates at very, very high EBITDA multiples. And this is something that's back to the Christie's guys, but you know, we'll resist the temptation. Chris and I have had many debates about what is EBITDA, and I've been criticised by some people saying, well, surely you must know what EBITDA is, Alan, you're an accountant. But it's not quite as simple as that, unfortunately. But the sort of very, very high multiples of EBITDA paid by private equity-backed corporates maybe have gone perhaps forever, and that's not necessarily a bad thing unless you were somebody who was expecting to capitalize by selling your practice, but it's a sort of a slight dampening at the top of the market. Maybe at the bottom end with associates, Andy mentioned the point about associates being cheesed off about their lot in life. That is perhaps a ramping up of values at the bottom end. So I do not see in the medium to long term a diminution in values, although Sabina also said that perhaps we are guilty, that the participants in this at some or other forcing prices up through webinars like this. I think that if that is the case, it's purely temporary. Chris?
Just on that point about these webinars, pushing the price up, when it comes to evaluation, we're very much reliant on the data of the sales that have actually been achieved, because essentially we're putting our professional integrity on the line. We can be sued if we get it wrong, which is why the banks use our valuations as the sort of, this is what we can lend against. So we're not driving the market by doing these presentations. We're simply, when we're valuing, we're following the market of what people have actually been prepared to pay. So it's down to the market that sets the price, not the sales agents necessarily, definitely not the valuers, because as I say, we're following. If somebody's prepared to pay the high multiples, then that sets the tone for the next valuation, for the next sale, and so on. I think it's also important to remember that we did see a little bit of a softening of those very high multiples that the corporates were paying, but they've still got equity clients, equity owners to satisfy. They still have to buy X amount of practices year on year, and there's a certain price people will sell at, and it will still dictate that high multiple price if it's a very good practice. From a valuer's point of view, I'm not going to be valuing at 16, 18 times like we saw for some of the practices back 2 or 3 years ago. But if the market dictates that, then Alan, we'll be valuing at levels.
You're following it, yes, no, I get that. Okay, but now the bit that everybody's been waiting for, how to save tax. So Charles, there's a question here, which if ever there was a hospital pass, that's it. But how does deferred consideration affect entrepreneurs' relief and capital gains tax? So there we are, Charles.
Right, okay. Well, excuse me. To answer that question, I probably have to go back at first to the situation before the March budget, which, as perhaps at least some of you can recall, was actually pre-COVID, because it was delivered in the early part of March. And at that budget, Rishi Sunak, the Chancellor, quite dramatically slashed the amount of capital gain that would attract entrepreneurs' relief. Up until whenever it was, I think it was the 11th of March, you had a cap of £10 million. So your first £10 million of capital gains could potentially attract entrepreneurs' relief, and you'd pay tax at 10% on that, and only excess gains above 10 million would be charged at the higher rate of 20%. So typically, if you had a deferred consideration deal back then, you'd be looking at the numbers and you'd be actually trying to work out what was the maximum deferred amount you could achieve. And then in your capital gains computation, you would be returning that maximum figure as if it had been achieved at the time of sale, because that way you could actually lock in the CGT entrepreneurs relief. If you ultimately achieve that figure, all well and good. And if you achieved a lower figure, there was the capacity to amend that capital gains tax computation. And if you hadn't already paid the tax, which might have been quite likely if it was a disposal early in the tax year, because the CGT wouldn't have been payable until 31st of January following the end of the 5th April year end in which the capital gain had taken place, then there was no harm done. Or if you'd already paid the tax, you would get some of it repaid by amending the return. But because in that March budget, he slashed the £10 million down to £1 million, I think there is now a school of thought that would say, well, if I was entering into a sale and I'm going to get, let's say, 1.5 million on day one, and there's going to be some deferred consideration payable over the next 12, 18 months, 24 months, the maximum I'm going to get at 10% is going to be the first £1 million gain, and the next £500,000 gain is going to be taxed at 20%. So therefore, I might be quite happy for the subsequent deferred amount to just be treated as a separate capital gain and fall into a following tax year when, yes, it's still going to be taxed at 20%, but the interval between getting that money and paying the tax is going to be that bit longer, and I'll have another year's annual exemption, etc., etc. So I think, as I say, it really probably then depends on the numbers, because the reduction from £10 million to 1 million was so dramatic and has made a difference to a lot of what would have been the practice beforehand.
Well, thanks for that, Charles. And I think it was a very good unprompted question from the audience, because we have found a significant amount of our time has been spent in talking to clients that are lucky enough to be anticipating gains of more than £1 million, because it ripples out into other planning mechanisms. Andy and I spent increasing amounts of time talking about clients that are accumulating cash. And for those of you who aren't aware of why that could be a benefit, if you accumulate cash within a limited company and then you sell your limited company on exit, which is the usual way of exiting when you're operating through a limited company, then that could be a really tax effective way of liberating cash. But that is the impact of that has been diminished significantly by this reduction in entrepreneurs relief, the ceiling of it. In fact, it's not even called entrepreneurs relief now.
It's called business assets disposal relief.
Thanks, Charles. And one day I'll remember that. Katie, would you like to chip in?
Charles, with all of the talk in the media about capital gains and how people are going to pay for COVID, what are your views on what might be coming?
Yeah. Well, first of all, because the reduction in entrepreneurs relief, now rebadged business asset disposal relief, or BADR, as I choose to remember it, because that was so dramatic and it was done so recently, I would be very surprised if the Chancellor does anything further with that £1 million limit. So I'm not a betting man, but I would almost be prepared to bet that the £1 million limit and the 10% would stay in place. The unknown is what he does with the capital gains tax rate otherwise, because again, and I think we touched on this perhaps in the last webinar, or maybe I did it in a supplementary question. If you think back to the very last budget that George Osborne delivered in 2016, before we had the referendum, he actually reduced the top rate of capital gains tax from 28% to 20%, with the exception of gains on residential property that wasn't attracting principal private residents. So things like buy-to-let, second homes, you now pay 28% CGT on that. Otherwise, everything else was 20%. And the other one, which doesn't need to detain us, is the carried interest for venture capitalists, which has been attracting a lot of publicity. But it does strike me there's an obvious move that the Chancellor might make, and which probably wouldn't do him terribly much, would probably do a great deal of political damage, might be to take the top rate of capital gains tax back up to the 28%, which was where it was during the whole time of the coalition government, because that was the rate it was. So that, I think, is a distinct possibility. He could do something even more dramatic, but I think personally that's unlikely, and that's align CGT rates with income tax rates. But that would be, I think, going a step too far. The other thing also to say is, at the moment, unless something's happened in the last day, because I haven't seen any news today, I don't think we actually yet have a specified date for the autumn statement. Now, if you go back 2 or 3 years, there was an autumn statement delivered as late as virtually the end of November, so we could still get one before Christmas. But there has also been speculation that the autumn statement might be deferred until the new year. There might be a mini spending review before Christmas. The actual autumn statement, at which you might expect any sort of tax changes to come in, may not actually happen until we get into 2021. But that's, if there was to be a change, I would think it would be to what I might call the 20% rate, rather than the Entrepreneurs Relief Business Assets.
Thanks for that, Charles. So just advance warning to all of the panelists. We've got about 5 minutes left, and Chris came up with an interesting suggestion that for us to give our thoughts about how the NHS contract is going to evolve. He's obviously got a crystal ball in relation to that, but we'll have a quick whiz around in relation to that. But whilst you're collecting your thoughts, there's another question that's just come in as well about can we utilise rollover relief on capital gains tax? And I don't need to ask Charles that one, because I know the answer myself that you can. But the most clients, when they're talking about this rollover relief, and that is a way. Let's say that you are selling your practice for £1 million, you make £1 million gain, and you're eligible for only the 10% tax rate, so you're paying £100,000 capital gains tax. There is a way that you do not actually suffer that tax payment. But in order to do so, and here's the catch, you have to reapply all of the sale proceeds. You don't go out and buy another practice for £1 million. If you've sold your practice for 3 million, making a 1 million gain, you have to spend all of the 3 million. But the good news is it doesn't have to be a dental practice. For those of you who are fed up of being dentists, you can go and buy a restaurant or a, I don't know, a car dealership, whatever you like. It has business assets, as in goodwill, freehold, etc. So that's the answer to that one. So can we just pop round now then? As you suggested the question, Chris, what's your thoughts about the evolution of the NHS contract?
Well, to be honest, I was hoping you asked Nigel first. I mean, who knows? I mean, we've obviously had, most of us have been around long enough to know that we've had reform on the cards for the best part of 10, nearly 11 years. Clearly, it's not sustainable at the current levels in terms of 20% of your contract till next year, and given the follow time and everything, you can't get through patients quick enough. So there's no way we're going to be able to get back to the same sustainable contract that we've had before. I think also the important thing is that access has always been a problem, and has been for the last 15 years that I can remember. So I think the contract needs to be more capitation led, and more freedom for dentists to provide correct treatment for the patient that they're seeing. I think the traffic light system that's proposed to some extent will work, but I think dentists need to spend longer with each patient and being given the funds to do so. How that will work in reality and practice, I'm not sure, but there's greater minds thinking on it than I am, and I think this is the best opportunity we've got to make the contract right for everyone.
Okay. Before I ask Nigel, has anybody got any thoughts? Any others that the non-dentists? Any thoughts as to? Clearly, none of us know what's going to happen, but what do you think should happen? Louise, have you any thoughts about that?
Well, I suppose I'm just thinking from a legal point of view. It will make life tough if they sort of, because the UDA is the currency we all understand, isn't it? If they kind of move away from that, how they pay people, and more for patient outcomes, quality of care, and so on, that is going to make it tough in a legal context about clawbacks, etc., etc. So, don't know. Wait and see. Yeah. It's just UDA is a currency we all understand, isn't it? But I don't think it will be kept that way. No, it will go towards more patient outcomes and quality of care for sure.
Katie, you've got a vested interest in this with your family involvement in the dental world.
I probably have a bit of a controversial, cynical view, if I'm honest. I wonder whether this whole 20% thing is a way for the NHS to monitor whether it's possible to deliver lower levels while still keeping a certain patient base. If I were running it as a private organisation, you can kind of see a methodology where you maybe have a bigger central hospital practice, say, that you feed everything into. You know, the government, it's quite a fragmented market, isn't it, with lots of contracts out there. If you look at other areas of the healthcare system, it's all about, you know, consolidating contracts, so the government has less people to deal with. But like I said, it's my own personal, quite cynical view.
Okay. Before I come to Nigel, anybody else that has got a view that they want to put forward? What do you think, Nigel?
I've probably got a bit of a cynical view on it as well. I've worked with quite a few dentists in my time, and some very good, some very bad. But on the whole, my overriding thought of how the dental industry works is that dentists make the contract work no matter what the contract is. And so if they change the contract, dentists will find ways to make it work in their favour. The UDA system, I think, on paper, had the ability to be decent, but actually was made to be the system it is by the people who work within it. And I think that I hope that they can change it, because at the moment it in my opinion, it benefits neither the patient nor the dentist, and possibly the only person, the only organisation that it does benefit is the government. And that's what makes me think maybe it won't change too much in the favour of either dentists or patients, because it's too much of a political hot potato to get rid of NHS dentistry, and I think that it needs to move to a system where patients can spend more time with a dentist. And it's a reason why one of my practices I've left the NHS, because it was becoming increasingly more difficult to spend the required time with the patients. I don't know what they're going to do, but I hope that they come up with something better than what there is at the moment, that's more workable for us. Okay, well, thanks for that, and that's sort of interesting. I think that the crystal ball, wish we had a better one, because all of us depend on, to a greater or lesser extent, on the evolution of this, and ultimately how much profits are made out of NHS contracts and capital values. We're all involved to a greater or lesser extent. Okay, so I think we are probably slightly over time.
Can I just answer Sabrina's last question, because she's just put it on there.
Go on. Oh, sorry. Go on then.
Basically, Sabrina's asking, how do we make sure practices are valued at the right price? All of us are professionals in this business, and it's important to get the right advice from the right people and make sure the people that you're using know what they're doing. There's a lot of people and valuers and companies out there that will profess to be experts. You need to quiz people that you're working with and make sure they are, and make sure they know what they're doing, basically. So hopefully that answers that one.
Okay, thanks very much, Chris. Well, thank you very much to all of the panelists for giving up your time to come and give your thoughts, views, advice. I'm grateful for that. Hopefully our attendees are. And thank you to our audience. Thank you for tuning in an old-fashioned sense. Thank you very much, and hopefully we'll see you next month. Bye-bye.
Cheers, thanks.